it's flirting with tolerated. The silver bugs are angry. There's, all seven of them are angry about the fact that silver's outperformed gold, and they think in their time frames that it's underperformed gold. Pardon me. They think it should outperform gold. Most of the world doesn't know silver exists. My experience has been that when the generalist investor comes into a precious metals bull market, when the momentum has been established by gold, leadership changes to silver. I don't know when that will occur, but Jordan, you're not going to need me to tell you it has occurred. It's really dramatic when it does. There are some ETFs that have been pulled into the gold space because they buy stocks with earnings momentum. They've been pulled into the Wheatons and the Agnico Eagles. The generalist investor can't spell gold, despite the fact it's a four-letter word. We haven't seen anything. At the same time that we are seeing relatively good performance by a few gold stocks, we're still seeing money flow out of the indexes. The GDX, despite being up nicely, is having outflows, not inflows. So the only generalist investors that are in the gold space are what I would call gold investors in drag, people who are doing it inadvertently in index funds. It is amazing that investor perception around gold is so muted that retail money is flowing out of one of the best performing sectors in the market. This is not something that I've seen before. Well, first of all, there's been a lot of years where the GDX hasn't performed. To see the GDX perform as dramatically as it has, on the back of confirming data from the gold price itself, and see money flow out the index is something I haven't seen before. But I have no doubt that that'll self-correct. I'm true to what I do. There are lots of ways to win. There are people who are technical traders. There are people who are momentum traders. There are people who are sentiment traders. That's not what I am. I'm an investor. And by education, I'm a value investor. So I use the strategy that's worked for me that I'm comfortable employing. Because I'm comfortable employing my strategies, I'm unimpacted by volatility. People that have never developed a strategy or don't follow their strategy tend to be shaken out of their investments during times when they mistake volatility for risk. So I never change what I do. There was a time in the early part of the decade of the 90s when optionality was free. Nobody expected the gold or silver price to rise. And so you could buy gold assets in the ground for $5 an ounce, $10 an ounce, understanding that if gold repriced, that those assets would underprice. That worked because nobody was buying gold optionality. People buy gold optionality now. So in order to participate in that game, you're exposed to things like $2 billion market caps, which I don't do. I'm an absolute value guy, not a relative value guy. There are lots of other ways that work for people who are good at them, but that's what works for me. It's what I understand, so it's what I do. Construct a rough valuation metric. And when I say rough, I mean really rough. And for gold, I use the forward strip, which is to say basically 3,500. I use a 20% discount, and I use a 20% premium. And so I actually construct three models. And I look at my downside stress risk, which throws out the high cost producers. And I look at all three valuation scenarios. I have a bias as to where the gold price is going to go, but I don't know when, and I don't even know if I'm right. So for me, I use a pricing matrix. I would argue that by valuation metrics, using current gold prices, Agnico Eagle is cheaper after it doubled than it was before it doubled. I look at discounted free cash flows, and I look at the free cash flows that they were able to generate in 2023 versus the free cash flows that they're able to generate in 2025. And by those metrics, the stock is cheaper now than it was when it was selling at half the price. Remember that part of the equation is price, but most of the equation is value. I do a couple things. I compare enterprise value, which is to say equity plus debt minus cash, and I compare that to my estimate of the net present value of the company's assets from the assets that are currently in production, and I add to that expected net present value from their project pipeline. When I do that for Agnico Eagle, I'm not going to give you the number, but despite the fact that it's gone up, it's doubled, it's cheaper than it was before it doubled. Moves in gold prices affect, first, the companies that produce large amounts of gold. You can have a junior that's looking for gold, and the fact that the gold price goes up shouldn't really matter much to them because they don't have any. If the price of something you don't have any of goes up, who cares? The second thing is, Jordan, and I've learned this the hard way, I've graded tens of thousands of portfolios, as you know, for free over 30 years. And I've learned that most people aren't willing to do the work to be speculators. They should be investors. In a gold bull market, the beta, which is to say the index itself, generates 300 or 400 or 500% returns. You can buy most of the beta in the 4 or 5 best gold companies. Maybe you underperform the average because they actually don't have the leverage that the lousy companies do. But you can buy 85% of the beta for 10% of the risk by buying the best of the best, and then you can get on with your life. You can go fishing or go gardening or read books or play with your kids. And for people who aren't addicted to it like me, that's a good answer. That's a good thing to do. The real classroom is very good. There's 200 hours of instructional programming there, including 11 hours of real how-to called Introduction to Natural Resource Investing. There's a lot of free sources. There's a lot of paid sources, and a lot of them are good. It's important that you consume those sources you consume sources that communicate to you. There are people out there who, I can't imagine this, Jordan, but they consider me to be an arrogant, smug human being. They probably shouldn't go to the real classroom. I am who I am. And if you can't consume the information from me, there are other places to get it. But the point is, do it. I think the important thing, Jordan, that people must do when they come into the sector is they have to do what you did. They have to assess themselves. They have to assess their strengths, their weaknesses, their goals, their time frames. And then they have to begin the process of systematic education. The sector doesn't change that much past its prologue, but you have to do the work to understand what the past was so that you can use it as prologue. You did the work. And newbies to the sector need to ask themselves whether or not they're willing to do the work. Does it interest them? If it doesn't, if they understand the gold narrative and they want to use gold to protect themselves in the future, they should buy some gold, and they should buy the best of the gold stocks, the best, and they should get on with their life. If, by contrast, they begin to get absorbed by it, they have competitive instincts or intellectual instincts like your own that suggest that they want to outcompete the beta, that they want to generate alpha. That's very different. Then they need to begin the process of outcompeting other investors. And you do that by having better access to information and a better ability to assess information. Investing is hard work. I ask people to have the number of stocks in their portfolio that correspond with the number of hours per month they spend studying the stocks. And that doesn't mean listening to podcasts. It means reading 10Ks and 10Qs and proxies and resource statements. The slug work, listening to the quarterly analyst calls, which are free. If you aren't willing to spend 10 hours a month, you shouldn't own 10 stocks. You shouldn't do this. So the first thing is laziness. The second is a mismatch between their strategy and their tactics, particularly around time. Many resource investors have come to the space understanding the timeframes required in resources. They see something where supply is short, where the industry is in liquidation. They understand the contrarian thesis. They buy because they think electricity demand is going to go up, and therefore the copper price is going to go up. They understand intuitively that it's going to take 5 or 6 or 7 years for that to happen. But then they have trauma holding a copper stock over a long weekend. The juxtaposition between the time required to affect one's strategy and the tactics that one uses with their own holdings is probably the biggest preventable investment mistake that I see. I buy these stocks with the anticipation of a 5 or 6 year holding period. Or if it's an exploration stock, I buy it with the anticipation of an 18-month holding. If you buy a stock because you think that the drilling campaign will confirm the work done with geophysics and surface exploration, and you understand, as an example in northern Canada, that will require 2 field seasons, what that means is that the reason that you bought the stock likely will not occur for 18 months. If you aren't prepared to hold the stock for 18 months, why would you buy it in anticipation of an event that you won't see? But many people do that. Another thing, Jordan, which is going to really greatly amuse you, and most of your listeners will screw up, is in a bull market, something we haven't seen yet, or at least your listeners haven't seen for a long time. There will be occasions when I buy a stock in anticipation of the answer of unanswered questions, let's say the aforementioned drilling campaign, and the greed associated with that possible outcome takes hold of the market. There are occasions where stocks appreciate to my target before the unanswered question has been answered. In those cases, I always sell enough stock, irrespective of what I think the outcome might be, that I de-risk it. If my target is met before my question is answered, I always sell enough stock to get my capital back. Sometimes I sell it all. If you come into a market where you're making money too easily, you got to remember everybody else is making money too easily, and you're coming to the end of a good thing, and you haven't made the money if you don't get to keep it. People hated them all. You could look on the internet, and people that had uranium as part of their internet handle were capitulating. It doesn't get better than that. So although I had a good position in uranium, I bought some of the uranium stocks just in anticipation of the removal of hate from the trade. And I've been selling those positions. My reason to own the stock has now gone away, so the stock has to go away. By nature, I'm not a trader, but I remember back many years when I used to run a fairly large retail brokerage firm. One of the things I would do is every day I'd go into the cage, and any day where 80% of the transactions or more were buy transactions, I'd sell something. I decided the market was overbought. And any day where 80% of the transactions were sell transactions, I'd buy something, figuring the market was oversold. And occasionally I made a mistake, but I got to tell you, That was the only trading strategy I ever was around in my life. It really worked for me. I'm not normally a short-term guy, but I love hate. And paradoxically, I hate love. The informal tool that I've used for 30 years has been the frequency or infrequency of transactions by prospect generators. When I see prospect generators in their quarterly reports to shareholders showing increases in transactions, which is to say them being able to farm out more projects than they were a year earlier, when I see this across the length and breadth of the 40-something prospect generators that exist, I know that the game is on. I know that the financing window is open. I know that management teams who haven't taken on projects because they prefer to get paid salaries are becoming more aggressive, and that means that money's becoming available. There are probably more efficient indexes than that, but I don't know them. I follow funds by actually follow funds, which is to say, when I see transactions that are being funded by the vendors, then I know money's back in the space. And by the way, money's back in the space.